It is not yet necessary to start reducing rates. The U.S. Federal Reserve's implementation of easing policies has not been expected or evaluated by us among the videos on this channel since last year. The reason for this is that the hexagrams in the Yi-Jing, or Book of Changes, indicate that the process of cutting rates is not yet initiated. Are you aware of this? The current economic development trend, as indicated by the Yi-Jing hexagram, suggests that the world is slowly changing. At the end of the video, we will provide an explanation for this phenomenon to you. Welcome to our channel. In today's video, we explore the fascinating intersection of ancient wisdom and modern finance. Discover how the principles of Yi-Jing, particularly Jì Jì Guà, can guide your investment strategies. Learn how to achieve balance, foresight, and success in your financial decisions. Stay tuned for valuable insights and practical advice that you can apply to your investment journey. The Fed's policy is based on outdated or stale data, particularly in its calculations of inflation related to housing and rents. The Fed's higher interest rates are not in line with reality, as they seem to be relying on older data. The stock market is on fire, breaking records left and right like an overachieving student on test day. We're talking about a real market rally, folks. It's enough to make you want to do a victory dance on Wall Street. But hold your horses for a second. Thanks to the latest macroeconomic reports, it looks like we're finally healing from the wounds of high inflation. The Fed's been working hard, and it seems like their efforts are paying off. This means we're looking at a potential gold mine for investors. This sets the stage for one of the most ferocious bull markets we've seen in ages. I'm talking about a market that's ready to charge ahead like a bull in a china shop. But hey, not everything that glitters is gold. Even in a raging bull market, there are a few stocks you should drop like hot potatoes. While everyone's riding the wave of this bullish market, some companies are desperately trying to keep their heads above water. And trust me, you don't want to be caught holding the bag when these companies start to sink. It's time to face reality and consider pulling out before you end up with a financial headache. Buckle up and let's get into it. First up, we're putting Company A under the microscope. Now, this company might seem like it's riding the bull market wave, but don't let that fool you. We need to look beyond the surface, people. Their latest earnings report? Let's just say it was about as exciting as watching paint dry. Sales are down and their profits are thinner than a sheet of paper. We're talking about a company that's struggling to stay afloat in a sea of competition. And speaking of competition, let's talk about the elephant in the room. Their competitors are running circles around them, coming out with innovative products and stealing market share left and right. It's like Company A is stuck in the slow lane while everyone else is speeding ahead in the fast lane. Look, I'm all for giving companies the benefit of the doubt, but Company A's performance is setting off alarm bells. It's time to face the music, folks. This stock is a potential time bomb waiting to explode. Let's break down why Company A is struggling. First off, their sales are down, and not just by a little bit. We're talking about a significant drop, which tells me that they're losing ground to their competitors. This is not the time to be complacent. And speaking of competitors, Company A is facing an army of them, all vying for the same piece of the pie. These competitors are leaner, meaner, and more innovative. They're playing chess while Company A is stuck playing checkers. Now you might be thinking, but Jim, maybe Company A has a plan to turn things around? Well, I haven't seen any evidence of that. Their latest earnings call was a masterclass in corporate jargon and empty promises. They need to get their act together, and they need to do it fast. Otherwise, they're going to be left in the dust. Remember, in the stock market, you're either growing or you're dying. And right now, Company A is looking pretty sickly. Listen up, because I'm about to give you some tough love. Investing in the stock market isn't for the faint of heart. It requires careful analysis, a keen eye for detail, and the willingness to make tough decisions. When I see a company like Company A with declining sales, increased competition, and a management team that seems clueless, my gut tells me to run for the hills. And you know what? You should listen to your gut too. Don't get me wrong. I'm not saying that every company with a few bumps in the road is doomed to fail. But when you see a pattern of negative signs, it's time to take a step back and ask yourself, Is this a risk I'm willing to take? Now, I'm not in the business of telling people what to do with their money. You do what you want with your money. But I will say this, holding on to a stock that's showing all the warning signs of a sinking ship is like holding onto a grenade after you've pulled the pin. The market is full of opportunities, and there's no need to waste your hard-earned money on a company that's going nowhere fast. Remember, selling a stock isn't admitting defeat. It's making a smart decision to protect your investment. Sometimes the best offense is a good defense. All right, let's move on to Company B, another company that's been struggling to keep up with the bull market's pace. Now, Company B might have a flashy image and a catchy slogan, but don't let that fool you. We're here to talk about fundamentals, people. Their latest earnings report was nothing short of disappointing. It was like watching a deflated balloon slowly drift towards the ground. Their profits are shrinking faster than ice cream on a hot summer day, and their revenue growth is about as exciting as watching grass grow. Look, I get it. The market is constantly changing, and companies need to adapt to survive. But Company B seems content with resting on their laurels, hoping that their past glory will carry them through. Well, I've got news for them. Nostalgia doesn't pay the bills. They need to innovate, they need to adapt, and they need to do it yesterday. Otherwise, they'll be left behind in the dust of their competitors. One of the biggest red flags I see with Company B is their lackluster performance in a market that's practically on fire. I mean, come on, everyone else is throwing a party, and Company B is sitting in the corner nursing a glass of warm milk. They're losing market share faster than a beach ball in a hurricane, and their once loyal customers are jumping ship to the competition. It's like watching a slow-motion train wreck, and I'm not sticking around to see the carnage. Now, I understand that every company goes through ups and downs, but Company B's downs seem to be outweighing their ups lately. This begs the question, what's the problem? Is it their management team? Is it their product line? Is it their marketing strategy? Whatever it is, they better figure it out fast because the clock is ticking. Company B used to be a household name, a brand that was synonymous with quality and innovation. But lately, it seems like their brand power is fading faster than a pair of cheap jeans. Their products are starting to feel stale and outdated, like a loaf of bread that's been sitting on the shelf for too long. The competition is smelling blood in the water, and they're circling like sharks, ready to snatch up Company B's customers. And you know what? I can't say I blame them. If Company B wants to stay relevant, they need to step up their game. They need to remind consumers why they were once the top dog in the industry. Now, I'm not one to completely write off a company, even one that's facing as many challenges as Company B. But I'm also a realist, and the reality is, Company B has a long way to go before they regain their former glory. They need to address their declining sales, their shrinking market share, and their fading brand power. And they need to do it with a sense of urgency. The good news is, it's not impossible. Many companies have faced similar challenges and come out stronger on the other side. But it takes a combination of factors, a strong leadership team, a willingness to adapt, and a bit of luck. The question is, does Company B have what it takes? Only time will tell. We're smack dab in the middle of a bull market, folks. The Dow's soaring, the SP's setting records, and everyone's feeling like a Wall Street wizard. It's enough to make you want to throw your money at anything with a ticker symbol. But hold your horses, because not all that glitters is gold. And today, we're putting Company C under the microscope. This ain't no FANG stock riding the tech wave. This is a company stuck in the slow lane while the market zooms past. Now, I'm not saying Company C is a guaranteed loser, but there are some serious red flags popping up faster than you can say, sell, sell, sell. Their latest earnings report? A big old whiff. Revenue down, profits stagnant, and their guidance? Let's just say they wouldn't know growth if it hit them in the face. Look, I get it. Sometimes companies hit a rough patch, but Company C's problems run deeper than a temporary blip. They're facing a perfect storm of headwinds, from increased competition to changing consumer tastes. Remember Blockbuster? They didn't adapt, and look what happened to them. Now, I'm not saying Company C is the next Blockbuster, but they're playing a dangerous game of catch-up in a market that waits for no one. Bottom line, don't let the euphoria of a bull market blind you to the warning signs. Company C might be tempting with its seemingly low price, But remember, a falling knife cuts deep. Do your homework, trust your gut, and don't be afraid to take profits off the table. There are plenty of other fish in the sea, and right now, Company C is looking more like a bottom feeder than a prize catch. Let's talk about competition, folks, because in the business world, it's a jungle out there. And right now, Company C is surrounded by bigger, faster predators with sharper claws. Their core product, the one that used to be the king of the hill, it's looking as outdated as an 8-track player in a world of Spotify. The competition? They're not just innovating, they're launching product blitzkriegs that would make a general blush. Sleeker designs, better features, and prices that would make you think they're giving the stuff away. Meanwhile, Company C is stuck doing the corporate shuffle, trying to squeeze a few more bucks out of a tired old formula. It's like they're bringing a knife to a gunfight. And let me tell you, that's a fight they're not going to win. They need a game changer, a Hail Mary pass, something to shake things up and get them back in the game. A new CEO with a fresh vision? A bold acquisition to acquire cutting-edge technology? Listen, I'm not saying it's impossible for Company C to turn things around, but they need to act fast, and they need to act boldly. The clock is ticking, the competition is circling, and if they don't make a move soon, they'll be the ones getting taken out of the game. They say the customer is always right, but it seems like Company C is stuck in a time warp, completely out of touch with what consumers want in today's market. It's like they're stuck in a 1950s sitcom, while the rest of the world is binge-watching streaming services on their phones. The modern consumer is savvy, connected, and demanding. They want products that are innovative, sustainable, and personalized. They want experiences, not just transactions. And what's Company C offering? The same old with a fresh coat of paint and a tired marketing campaign. It's like they're trying to sell rotary phones in the age of the iPhone. Look, nostalgia might be big, but it's not a business strategy. Company C needs to wake up, smell the coffee, or the kombucha, or whatever the kids are drinking these days, and realize that the world has moved on. They need to ditch the outdated playbook and start listening to their customers. Embrace the digital age. Invest in research and development, and figure out what the consumer of tomorrow wants. Because if they don't, they'll be left behind, a relic of a bygone era. So here's the million-dollar question. Is it time to sell Company C? Now, I'm not in the business of giving financial advice, but let's just say I wouldn't be caught dead holding on to this stock like it's a winning lottery ticket. Look, the writing's on the wall. Declining sales, fierce competition, out-of-touch management, the list goes on and on. Some folks might tell you to buy low, sell high. But let me tell you, there's a difference between a bargain and a value trap, and Company C is starting to look like a bear trap with a can't-miss sign on it. Remember, in the stock market, you never go broke taking a profit. Sure, there's always a chance that Company C could pull a rabbit out of their hat, but at this point, I'd rather bet on a snowball and a heat wave. Don't be the last one holding the bag when the music stops. There are plenty of other companies out there with strong fundamentals, innovative products, and a bright future. So, if you're sitting on a pile of Company C stock, maybe it's time to cut your losses, take the money and run, and invest in something with a little more pep in its step. Remember, bulls make money, bears make money, but pigs get slaughtered. In today's fast-paced world, ancient wisdom can provide a calming and insightful perspective. The Yi-Jing, an ancient Chinese text, offers timeless advice that can be applied to modern investment strategies. Particularly, the Jì Jì Guà hexagram teaches us about achieving balance, maintaining success, and preparing for the future. Jì Jì Guà translates to already fording, symbolizing completion and success. It highlights the importance of maintaining balance and preparing for future challenges, emphasizing that perfection can lead to complacency and stagnation. The Federal Reserve, often seen as the economic puppet master, controls interest rates, money supply, and financial stability. Its decisions impact everything from mortgage rates to stock market trends, similar to how the principles of Jì Jì Guà influence strategic planning and balance. The current economic landscape, characterized by slowing growth and rising unemployment, mirrors the balanced yet precarious state depicted in Jì Jì Guà. This hexagram teaches us the importance of preparation and adaptability in maintaining stability. Unemployment is rising modestly, part of the natural economic cycle. Strategic planning, as advocated by Jì Jì Guà, can help manage these trends and mitigate their impact. The Fed envisions a long glide back to the target inflation rate, maintaining control and stability. This mirrors Jì Jì Guà's emphasis on balanced and thoughtful progression. The Fed's decisions rely on a plethora of economic indicators, forming a comprehensive picture of the economy. This data-driven approach is akin to Jì Jì Guà's reliance on balanced and informed decision-making. The Fed might implement one rate cut, two cuts, or none at all, depending on economic conditions. Each scenario requires a balanced approach to ensure stability, much like the teachings of Jì Jì Guà. Hold on to your hats, folks, because we're diving into the thrilling world of the US Federal Reserve and interest rate cuts. Now I know what you're thinking. Economics can be as dry as a desert. But trust me, this is more gripping than a season finale cliffhanger. So, let's jump right in and see what the Philadelphia Fed President Patrick Harker has in store for us. Think of the Federal Reserve as the economic puppet master. It controls the strings of interest rates, money supply, and financial stability. Without it, we'd all be like toddlers let loose in a candy store, chaotic and unpredictable. The Federal Reserve's decisions ripple through every corner of the economy. From the interest rate on your mortgage to the stock market's mood swings, it all traces back to the Fed. So when Harker speaks, Wall Street listens. And lately, he's been dropping hints about the possibility of an interest rate cut. Now, before you get too excited, remember that these things are never a sure bet. The Fed's careful approach, balancing growth with inflation risks, mirrors the tightrope walk advocated by Jì Jì Guà. Market reactions to these decisions are swift, reflecting the dynamic interplay of economic forces. But the mere whisper of a rate cut can send shockwaves through the market. So buckle up, because things are about to get interesting. To put it simply, we have witnessed that it is not only feasible to combine ancient Eastern wisdom with modern financial strategies, but it is also possible. This is a revolutionary invention. From embracing change to finding a balance between empathy and determination, this perspective on business management is refreshing thanks to these principles. Therefore, let's stay optimistic. These timeless and timely strategies can help businesses thrive. The importance of balance and smart strategy cannot be overstated. The key is to find the perfect spot and maintain agility, just like a tightrope walker with a safety net. To navigate the future economy, it is crucial to adopt careful and smart strategies that emphasize balance and adaptability. The current global market situation is not a simple matter. It has both favorable and unfavorable factors, as well as opportunities and risks. The environmental resources of each region on Earth are unique due to their differing latitudes and longitudes. We can summarize real-time opinions using artificial intelligence operations, such as neural networks, that take into account regional characteristics and national economic data. By watching our videos every week, you can keep yourself informed with a wealth of information that will improve the quality of your life in many ways with minimal time investment. In order to survive in these volatile financial environments, it is crucial to be able to adjust and avoid increased risk. Regardless of how experienced you are in investing, it's crucial to keep an eye on our video debuts to make better decisions. It's crucial to remember that knowledge is not just a tool to enhance your value, it's also a power. If you have any topics you're interested in, feel free to leave a message. To conclude this episode, I want to express my gratitude to all the viewers for their support. If you find that today's video is helpful, please like it so that you can easily find it later when you need to watch it. I want to express my gratitude for your attention. Thank you.